Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Advanced Charting Techniques. And yeah, we talk about charting indicators each week in this series, and one common complaint that traders have about so many indicators is they only look at price. Has anybody ever had that complaint about an indicator? It's quite common to ignore other potential elements in the consideration of a trend and reversals of those trends. So today we're going to be exploring an indicator that attempts to address some of those other maybe missing variables. This is known as the Klinger oscillator, sometimes known as a Klinger volume oscillator, and it incorporates elements of price movement, but are they also supported by volume changes and volatility? Are we going largely in one direction or another? So I think it's going to be an interesting discussion. We're going to be building an example trade system around the Klinger oscillator and actually placing an example trade before we're done. Before we can get to any of that, though, let me first of all say hello to everybody who's already chatting in. Great to see so many of my familiar Friday attendee names out there. Hi there, Will and Josh MB, Danny, Chris B, Lola, Frank, Ocean Life, Christopher, and everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions in these webcast discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in the live discussion. This is, as I mentioned, a Friday webcast series, and we kick things off promptly 1 Eastern time. We'd love to have you here in the live stream audience. And to help us out with that live stream audience, I have my very good friend Mike Fairborn. He's going to be hanging out in the chats. He's going to be answering any questions that come in through that chat function on YouTube that I can't get to just during the flow of the presentation. As long as they're not too far off topic, Mike's there to help you pick up some of the slack. So thanks for having my back there, Mike. And Mike and I would also like to issue an invitation to everybody watching. If you have an account on X, you should be following your favorite presenters there. It really is the very best place to connect with me in between these live streams. And I guess I should say, it's the only place to connect with me in between these live streams. So follow Mike on X at Mike Fairborn CS. You can find me on X at Cameron May CS. But let's get right into this. And of course, as we talk about charting and trading, there are risks associated with these sorts of activities. So bear these important disclosures in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right, so let's set the agenda for the day. First thing that we're going to do is have a quick peek at our two existing paper money example trades, and we'll quickly revisit the technical logic of those trades, see how they're coming along. Then we're going to look at the S&P 500 through the lens of what we call our trend value momentum strategy set. And that's going to set the stage for our discussion of this, what I think is likely to be a new indicator to a lot of you, the Klinger oscillator. So let me know. Sometimes this is abbreviated to KO. Is it a knockout oscillator? We'll find out. Also KVO sometimes, just a matter of labeling. But in any case, are you familiar with the Klinger oscillator or the Klinger volume oscillator? Chat and let me know. But that's going to be what we're doing today. Maybe introducing a new oscillator to some of you, planning and placing a new example trade based on that approach. But let's go to our Thinkorswim desktop trading software platform. And if you're not familiar with this software that we're using, it's called Thinkorswim, and it can be downloaded from within your Schwab Online account. You just go up to the Trade tab. Doesn't cost anything to do this, by the way. Go to the Trade tab, look for Thinkorswim in the menu, and then just click on a little blue bar that's going to guide you through the process of downloading it. Okay, this is what I suspected. Mary says, I haven't heard of this at all. Chris B says, new to me. Jay Richardson says, never heard of it. You'll love that you'll learn something new in every week in this class. That's fabulous. New to you. Okay, it looks to me like I don't see a single person who is familiar with the Klinger oscillator, so that's interesting. This is one of those that's maybe a little bit more complicated. It has an algorithm that generates a little bit more. It's actually a fairly layered algorithm that creates this indicator. I was tempted to type it all out. I think that might be a little bit heavy. but I will still explain, I think, in detail how it's constructed. I'm just going to try to put it more in more relatable terms. Okay. In any case, let's look at our existing positions. We have AMD, which was our trade from last week. If you remember, this one was taken using these Heikin Ashi candles in combination with a 9-period exponential moving average. And as long as our candle is above the 9-period moving average following a recent reversal candle, that was our entry. And we're waiting for another reversal taking us back down below that 9-period exponential. We're still above. This trade's actually doing just fine from last week. So on our 20 shares, up about $220. Not bad performance. Doesn't mean that it's going to work out ultimately. We'll see, but it's off to a nice start. Next up, we have, oh, by the way, if you weren't here to see the logic of these systems, I explain them in detail at the time we place them. We make a plan for the trade. We execute that plan. But you can find these just going to the archives of previous webcasts. So if you haven't done this already, make sure you're subscribed to our YouTube channel. It's called Trader Talk Schwab Coaching Webcasts. You can see it there on your screen. But you can subscribe by clicking on the subscribe button down the lower right-hand corner. It doesn't cost anything to do that. It literally only takes a second. But this is where we house our playlists of previous webcasts. So to find this series, you click on Playlists after finding Trader Talk's Schwab Coaching Webcasts on YouTube. Scroll down, it's about halfway down. Look over here to the right, you'll see my face about halfway down the list. Advanced Charting Techniques, and you can click on View Full Playlist. And then you can go back and look at those previous webcasts. Here was our Building a Short-Term Trade System with Heikin Ashi Candles discussion. So back to our trades. Our other trade, Marriott, it's right, look at that, $7 on 20 shares. We're a few pennies down on each share at the moment. Here was the technical setup for that trade. First thing is we use traditional candles. We also used a different set of technical studies. So let's switch our style here from a Heikin Ashi candle to just standard candles. Then we're going to come up to our studies and load up our study set that we saved for MAR. So this was our Arun oscillator plus a 10-50 crossover EMA approach. There we are. Basically, just to revisit this, here was the logic of the trade. We have a shorter term moving average combined with a longer term moving average. And as long as the short term is above the longer term, for some traders, they may consider that to be an intact upward trend. And then we're looking for an entry signal within that trend, which is found down below. In this case, we're using the Arun oscillator as our entry. And the specific entry here was our green Arun oscillator line rising up over our zero signal line. So that happened here. We took an entry just after, and we're going to hold on until we get a crossover in the opposite direction. So for some traders, I will say, though, sometimes we rise up here above the 50 line. And if we start to get multiple days with the Arun oscillator going sideways, that can kind of put them on higher alert. There are some that might look for a possible exit even before the crossover, but we're going to wait for this zero line crossover. So that trade, it's okay. It's basically at break even. We'll just let that one continue to work. But we need to plan and place a new trade, but we're going to do that with the backdrop of the S&P 500. And each week for the S&P, we review a trend value momentum set of technical studies. So if you want to see this, let me show you a quick way to find this. Now, we could just scroll down. We introduced this some time ago. Where was that? We can just read through. I'm glancing through one at a time. Trend value momentum. There it is, right there. Understanding the trend value momentum chart trading system. Now, I abbreviate this to TVM. So another thing that one could do, among other ways that we could do a keyword search, is go to the channel and just type in TVM. And there it is. There's our understanding the trend value momentum chart trading system. So here's that system in a nutshell. Let's load it up with our study sets. Let's go down and load our study set, our TVM strategy study set. But basically, our technical trader here might be using a combination of three. It's actually four indicators, accomplishing three tasks for that trader. One, as a confirmation of trend. A second, as a confirmation of value. And third, as a potential confirmation of momentum shifts. So specifically, our trend confirmation comes from a pair of triangular moving averages, a 50 and a 100, sort of an intermediate and a longer term moving average. And the interpretation here being if the 50, that's our green line, is above 100, that's our, what would we call that, rust line. In any case, if our intermediate is above the longer term, it might mean that price is generally strengthening over that intermediate trend time frame. And so that might incline a trader to be more bullish or to trade more bullishly if they use this sort of an approach. And that's not, I think, a huge surprise for traders who recognize that even just today, we just touched all-time highs again on the S&P 500. But trend, bullish. What about value? Is this a time where in the short term, a trader might identify value using an indicator like RSI? Maybe not. RSI actually just went into the overbought range and is starting to peel back. And what do we notice here? If I were to do this, somebody give this a name. I'm just going to draw two lines and somebody's going to know what I'm talking about here. What is that? Very, very common view of the RSI. This is known as a bearish divergence. It means that price is going up, but our oscillator, in this case, we apply that value assignment to it, but our oscillator is going down. So for some, what that might mean is, okay, the markets are generally bullish, but they might be getting a little bit top heavy, at least in the near term. So if we're waiting to get in an optimized time, maybe now is not the moment. Obviously, it's not a guarantee the markets aren't just going to go rocketing higher. They certainly could. But for an RSI trader, it might be quite typical to say, I'm gonna pump the brakes. Let's wait for this to come down again. Maybe wait for price to blow off a little bit of steam. And when we start to see that RSI rising again, that might be more reassuring to the RSI trader. Anyway, down at the bottom here, so trend, bullish. Value, not really present. What about momentum? This is interesting because it diverges from our momentum, from our value confirmation. Our momentum oscillator, typically interpreted when we see high and falling, that might mean that there's been buying momentum, but it's starting to falter a little bit. If it's low and rising, there's been selling momentum, but maybe we're starting to see some strengthening, maybe tipping from selling momentum more toward buying momentum. And if you squint your eyes right there, it looks like there's been quite a tug of war recently, not strong in either direction, but we did slip down into selling territory on that momentum indicator, but it's gone from bright red to dark red, kind of bright red again. We'll see. Momentum, there may be a shift there. Might be reflecting this little tug of war recently, but I think that some traders might still consider this to be slightly bearish momentum. Okay, so would anybody be surprised, maybe somebody is, for me to say, looks bullish, but maybe there's some caution for some technical reasons? All right, that's our backdrop here. How might this inform the way that a trader approaches the markets? Well, maybe if they're entering into new positions, they may just scale down those positions if they have these sorts of convictions about relative timing. Danny says in the MACD histogram, the difference between the value line and the average line. Danny, it's actually, the MACD is the difference between a 12 and a 26 exponential moving average. And it's a 9-period exponential average of that distance. If you really want to get into the weeds there. But yeah, it is actually a price interpretation. Yep. But for our purposes, we're just going to call it, is it buying momentum or is it selling momentum? And right now it seems to be more selling momentum, even though we touched all-time highs today. So maybe a little bit of caution. Maybe our trader, if they're using this sort of an approach, might be scaling down brand new positions, but we're going to be taking a new bullish trade nonetheless because, bottom line, markets are still very bullish. We've come off these lows back here with one of the strongest moves in history, top couple of dozen over that time frame. So let's go examine a new technical indicator. And this is going to be our introduction to the Klinger oscillator, created by Stephen Klinger. But I'm just going to clean up our charts. Let's go up here to our studies. Actually, let me switch it over to our example chart first. So we're going to use PLTR to acquaint ourselves with the Klinger oscillator. I'm going to go up here to our studies and just remove all of our studies. This doesn't delete the study set that I've saved. It just removes the studies from the chart. Allows us to see a nice clean chart. I'm also going to take off these lines here that aren't going to represent anything to our stock trader audience. So let's go to our time axis and uncheck that box. Even don't really need so many bars off the right here. Let's cut that down from 23 to 10. Click apply and click OK. So there's a nice clean chart of Palantir Technologies. And I'm going to apply this new technical indicator. So I'm going to go up to Edit Studies, and it's Klinger with a K. There we go. Kling, not Klinget, but Klinger. And we're going to choose the Klinger oscillator. If you were to go out and research this further, you will sometimes see Klinger volume oscillator. I mentioned that's an alternate name for this, but they're the same thing. I'm kind of in the camp of leaning toward just calling it the Klinger oscillator anyway, because volume, calling it the Klinger volume oscillator, oversells the volume element, undersells some other elements of the oscillator in my view. But let's add this to our chart. And there is a 13 here that's going to play a role in just a moment. Well, I'm going to click apply and click OK. And so we're left with this chart that consists of 3 lines. First of all, we have a 0 line. Above, generally positive, below, generally negative. Okay. Then we also have this purple line and the green line. Now, to assist with anybody, I know that for some of our viewers, we get thousands of viewers, and there are going to be some who can't quite see the distinction between subtle color differences. So let me do this. I'm going to change the thickness. That's not what I intended to click on. Let's click on this. Click our little gear. Let's make our, look at this. It even has the acronym KVO here, implying the Klinger volume oscillator. In any case, let's make that one a 3 out of 5. So for those who are watching, it's also a purple line, but I'll just click OK, click apply, and click OK again. There we go. But that is our Klinger oscillator. So we have these other 2 lines, purple and green. The purple line is the Klinger oscillator line, and the green line is known as what's called the signal line. And when there's a crossover of the Klinger oscillator through the signal line, that may be a bullish indication to our technical trader. And it might be a sign that prices are gaining some momentum through 3 different mechanisms and might be signaling an entry. So let me just highlight some of these. And I've qualified these in a very specific way that we're going to talk about. But I'm just going to highlight some of those crossovers that I'm talking about. But before we get into why traders look for those sorts of signals, I want to talk about how this thing is built. So this is going a little bit deeper into the weeds. I realize sometimes when I explain how these are constructed, some people's eyes can roll into the back of their heads. It bores them, or maybe it can be tough to follow along with some of these. Definitely can't fault you there. Just know that in my view, this is not the most important part of this discussion. Understanding how something is built is not necessarily as important to the trader as how it might be used to generate signals. But understanding how it's built can also explain why, at least conceptually, why it might have appeal to some traders. So here's how these things are built. First of all, they are moving averages. And just like a moving average that we might apply to a chart, let me apply like a simple moving average to our chart for reference, and we're actually going to use it in our trading here. Let's put on a 100 period moving average. Okay, click apply and click OK again. So here's our 100 period moving average, current value of 112.86. And we know, if we're familiar with simple moving averages, we know that's just telling us over the last 100 days, the average closing price of Palantir is $112.86. So it's using some value over time. It's calculating the average of that value and then plotting it as it changes over time. That's what a moving average does. These do the same thing, but it's a different value. It's not just price. The issue that some traders might take up with something like a moving average and other related technical indicators is that it only looks at price. Our Klinger oscillator looks at price and volume and actually involves a volatility metric. So let's talk about the construction of the purple line first. And it is constructed not using price, but something known as this sounds really cool, the volume force. What's volume doing, and is it doing it forcefully? Is a volume change, or is volume supported by bullishness or bearishness, and is it supported by big moves or small moves? That's really what volume force in a nutshell means. So what it does is it takes a look at today's volume, and I'm not even going to put volume on a chart because it doesn't matter. We're talking about this conceptually. We take the current day's volume and then multiply that. Well, we assign a value to that volume as being either positive or negative. Volume is either, in the Klinger oscillator, volume is either good or bad, right? And it gets an upvote if volume is accompanied by a price change from yesterday that was positive. It gets a downvote if volume is accompanied by a downward move from yesterday in price. Now that sounds like something else. Somebody tell me, what does that sound like? That sounds like on-balance volume, doesn't it? Yeah, on-balance volume actually looks at volume and makes it positive or negative based on whether there's a price change up or down from yesterday. But with our Klinger oscillator, this goes a little bit further than that. It's not just did today's close change, is it up or down from yesterday's close, but it actually looks at the average, or something called the typical price from yesterday. Typical price from yesterday? Let me zoom in here. And if we look at yesterday's candle, and if I were to ask you a question, what was sort of a typical price? Given how much yesterday moved around, what was a typical price for yesterday? Typical, that sounds kind of like average. It's close. The typical price looks at the high price from yesterday, the low price from yesterday, and the closing price from yesterday. Three values, we add them up, divide by 3, and that gives us a typical. Okay? So it winds up being somewhere in the middle of the candle. Sometimes more toward the high, sometimes more toward the low based on where the close is. And then we do the same thing with today. We calculate the typical price. High, low, close divided by 3. Did today's typical price go up or down from yesterday? And if it went up, then today's volume is positive. If it went down, then today's volume is negative. So we're building in price movement with volume, but not just using one point of reference from price. All right. So that's part of the equation for calculating our oscillator down here. Or actually, we're even just calculating at this point the thing called volume force. Did volume move forcefully accompanied by price? Next step, once we've determined whether volume is positive or negative, multiply it by 2. We just do. It just helps with the creation of the value for the oscillator. Moving past that, one more thing to do. We look at that change in typical price and divide it by the total range in price for the day from high to low. So we look at today's candle, and is it a big candle or is it a small candle? Because if we're getting a change, if we're getting strong volume, if we've gotten a positive price move, but it was a little one, that's going to carry less weight than if we got strong volume with a positive price move that accomplished a big move. So that's the equation. So it's literally volume times change in typical price times 2 times typical price divided by range. A bit of a mouthful. I told you it was going to be complicated, but that creates what's called the volume force. Is volume moving forcefully one direction or the other, positively or negatively? And then we generate a couple of exponential moving averages using that volume force. So we calculate it every day. We add it up over a course of time. In this case, we add it up over 34 days and generate an exponential moving average. Then we calculate a 55 exponential moving average using the volume force. And then we plot the difference between those two. And that gives us our purple line. Woo. All right. So did we just do some serious heavy lifting there to figure out how to get that purple line? Christopher, is that a nice simplification of a complex concept? Man, believe me, when I research this stuff, I understand how this works. But taking it from an algorithm to explaining the logic of why the trader even cares about that algorithm, that's a big step. That's where I try to flex my muscles as an educator. I hope I did that today. But what we're seeing here, the bottom line here, is if this purple line is going up, what does that bottom line tell us? It tells us that that volume seems to be increasing, and it seems to be increasing on upward prices in bigger and bigger candles. Does that make sense? If we start to see that slip, it could be any one of those three or a combination of the three. Negative volume, smaller candles, less positive. All of that. Okay, that's our purple line. So that's our Klinger oscillator. And you can see why this might have some attraction to somebody who is looking for something that's not just a reflection of price, but also reflecting price, volume, and volatility, the size of the changes. Now, finally, we have this green line. Fortunately, we've done the heavy lifting now. If we already know how to calculate the volume force, this is just a 13-period exponential moving average of that volume force value. So with all that done, we now know how our lines are calculated. The red line is just, well, how have the 35 and the 55. Ooh, I got to tell you one other thing about 35 and 55. Just occurred to me seconds before this launch because it was bugging me and I figured it out. Anyway, the zero line is just telling us whether the 34 is above the 55, period. All right, so anyway, much like so many other crossover systems, our trader here, using these three variables, is now just looking for a crossover, looking for strengthening of these three variables. And the signal is when we get our Klinger oscillator falling down below the 13-period moving average and then crossing back up above. That can be a sign of strength. It means that our 34 has kind of gotten some distance below the 55, but we're starting to see enough strength over a 13-day period that the trader sees that price may be strengthening in maybe a truer way. That's kind of a tough way to put it. Nothing's absolutely true or absolutely false, or not everything. We want to be careful when we apply the concepts of absolutely true or absolutely false in trading. But yeah, we might just be seeing a strengthening of price that's also supported by volume and by size of moves. That's what we might be seeing here. So let's zoom out. Let's talk about specific entry signals here. First of all, well, a common entry signal, I could actually mention a number. I've decided to zero it down to just one, okay? Just since I knew this was going to be some heavy lifting, let's make it lighter wherever possible. But I did say that I had a kind of a revelation right before this webcast started. If our purple line is generated using a 34 exponential moving average and a 55 exponential moving average, did anybody else think, why did they choose 34 and 55? Because we use moving averages of all sorts of different combinations. Very common ones are like 10 and 20 and 30 and 50 and 100 and 200, but sort of round numbers. Probably less commonly, but still common to be like 21 or 9, something like that. You don't hear about 34 and 55 very often. So as I was preparing for this, one question that still remained unanswered to me was why 34 and 55? And then giving it another 10 seconds of thought, I thought, oh, wait a minute. Totally makes sense. Those are Fibonacci numbers. So if traders follow Fibonacci's 34, 55. Those fall in the Fibonacci sequence. I get it. A little bit of technical justification there. Yeah, Lola, you were thinking about it. James and Chris B were on that as well. It only takes a moment for someone who's familiar with both of those to kind of make those connections. But in any case, that was fun talking about how it's built. Here's how it might be traded. Some traders trade the oscillator all by itself. And the first thing, well, one way that they might approach, I said I was going to use one signal. I'm going to use two variations on the same signal. But a common signal, as I've already highlighted here, is when our Klinger oscillator falls down below our 13-period exponential and then starts to rise up and through it, just a bullish crossover. And when that happens, that might be considered an entry signal. So let's kind of line those up on our Palantir example here. There was one here. There was one about here. There's one here. Line this one up. That was about here. Hope you can see these are not perfect. Looks like this one was about here. This one was right on that white candle. And there's a very recent one that was about right there on that sort of hammerish looking thing. Dragon Rider says, what is 34 and 55? Oh, what do they mean then? Why do we care about that? So a 34 and a 55, if we're just ignoring the fact that they're Fibonacci sequence numbers, they also are intended to represent shorter term time frames and longer term time frames. So if we're starting to see, let's say that in the shorter term, average price performance as supported by volume and volatility, if it's slipping down below the longer term, the 55, that might be seen as weakness. And that's when we're going to see this purple line going down, right? And we're below our zero line. Now, if there's a reversal of that, even if the 34 is still below the 55, just a reversal might be seen as potential bullishness, but the confirmation is when we cross up over the exponential moving average. Anyway, it's tough for me to simplify that. The simplest thing is to say, look for a crossover. So we have crossovers here and here and here and here and so on. Now, there are other times, though, there are other crossovers that I didn't highlight. Did you notice that? What about this crossover right here? What about this crossover right here? Purple went above the green. Purple went above the green. For some traders, that might be actionable. For others, they may steer clear of that one. And that's because these crossovers happened above the zero line, whereas these other ones happened below the zero line. The trader here is looking for things to be bearish for a period of time, hopefully dragging prices lower on increasingly negative volume and increasingly larger volatility, and then looking for a reversal of that. So we're looking for the Klinger oscillator to be below zero first, actually both oscillators to be below zero as a pre-qualifier for even looking for an entry signal. And then when we get a crossover, that may be a signal. Did it work? Does it work out perfectly every time? Nope. It looks like here it was fine, here it was fine, here not so good, not very valuable there. Here it was much better, here was fine, here was fine, and here it looked like it's done a pretty good job. In any case, just be aware with any technical indicator, there is the potential for failure. No technical indicator, no matter how sophisticated, is perfect. As a matter of fact, this is another little exercise I did. I thought, I wonder if there's a name for a trader's tendency to think that the level of complexity of a particular approach to the markets is equivalent to the likelihood of success. Why do traders? Is there a name for traders believing that? Because how many have just felt that way? The more complex a system is, the more likely it should be that it works. Because shouldn't it? Actually, that's called complexity bias. It actually has a name, and so the mere fact that something is complicated in trading, as in other parts of life, doesn't mean that it's an improvement over something else. Also, there's something known as the effort justification bias. We've gone to a ton of effort, and therefore this trade is going to work. No, doesn't work out that way. So a trader might want to have a plan in place, despite the effort and the complexity of their approach, plan in place for the likelihood that the trade might also fail. So let's make a plan for this. How might a trader trade this approach? Well, one exit to take potential profits is to wait for a crossover in the opposite direction. So for example, this entry here, the second most recent entry, may have had an exit right here. Let's draw in an opposite oval. Let's edit its properties to identify that as an exit signal. There we go. In this case, it looks like that one would have panned out with a profit. What about this one back here? That was yeah, we can eyeball that. That one was profitable. This one here, probably not. That probably would have generated a small loss right there on a relative whipsaw event. This one, yep, probably profitable. Anyway, I think you get the point. This is a relatively complicated indicator with a relatively straightforward way to approach it. Now, as a final element of this trade, some traders may use a trend element, like a moving average here, as a pre-qualifier for even considering a trade. So if we were to get an entry signal from our oscillator, but our trend indicator was bearish, they might just bypass that. So let's say that's our system. 100 period moving average with at least an upward slope to it, looking for a Klinger oscillator crossover below the zero line with the plan to take profits if we get a subsequent crossover of the Klinger oscillator. Now, what if the trade just flat out doesn't work? We could wait for the crossover, and that may serve as its own stop. Or the trader may look to recent support levels and say to themselves, well, even if I don't get a crossover, if we break recent support levels, that may also be an invalidation of the entry signal. Maybe I take the losses there. Yeah, so max for max, just said, where do we need to set the stop loss? For some traders, they don't set stops because the trade either works out or it doesn't. But yeah, if we are placing a stop, a common approach is to just go below recent lows. And in most cases, because of the way the oscillator is constructed, there should be recent lows right before a signal. Just like there was one here, there was one here, there was one here. This one was pretty close. Depends on where we identify that low. That one is fairly snug, and this one was probably right about there. There we go. So going a couple of dollars, a couple of percentage points below that, that might be the exit plan. So now let's go put this into practice on the more recent signal. I think Palo Alto had that, just slight upward bias. Do you see that? I don't know, you have to squint, but that moving average has just started to tilt upward again. It's been more sideways than anything. I think that there might be some trend traders who would definitely take an issue with this example that I've selected. I'm going to go ahead with the trade anyway, but slight upward bias on that 100 period moving average, although I got to acknowledge overall, and this is something that can happen when you're preparing a discussion, you focused more on the more difficult elements. You can overlook the kind of simpler ones. Carol says, why aren't we using the 200 simple moving average? Carol, we could. The trader might have a preference for a different trend line. It just depends. This could be paired with a shorter term moving average than a 100. Could go to a 50 if we want to be even more sensitive to recent price changes, or if we're just trying to get in on longer term moves. It could conceptually be used with 200 as well. I'm just using the 100 as an example. All right, but we are below zero, and we did get a crossover of the Klinger over the 13 EMA right there. Notice right here, though, there was a quick turnaround. There was kind of a whipsaw right there. That would have been valid according to the system and probably not produced a profit. In any case, there's our entry. Where might we place our exit? Well, in this case, if the trader is placing a stop, and I'm not going to, but if the trader were placing a stop, they may look at these lows right there and place a stop just below those, just as an example to get some repetition with that sort of approach. But for ours, we're just going to take the entry and wait for a reverse crossover. So let's go place our trade, and let's actually make a note here. Let's do two things. I'm going to first of all, put a circle or an oval around our logic for our trade. And that's going to be today. I'll put an oval around today's candles so we can quickly see it in the future. I'm also going to save this as a study set. So if you're wondering how I do that, save study set. Let's call it PANW. And this is our Klinger oscillator plus the 100 SMA. That's our system. Save that, and then we can retrieve that study set, our two indicators, anytime we want, even if we've taken them off of our chart. But let's go place our trade. Oh, one other thing I wanted to do. Sell on bearish crossover. So this can be useful when a trader is coming up with a plan for a trade. You can put it right there on the chart. Let's go to our trade tab. It's a $195 stock. We've been investing about $5,000 per trade. So let's stick with that. 100 shares would be $20,000. So we probably need to do about 25 shares. So let's click on the ask price. Let's change that to 25 shares. And the market's still open. I'm going to put a market order in. Obviously, with market orders, we might not be thrilled with the price that we pay. We're not guaranteed to pay the price that's on our screen, but let's click confirm and send. Going to buy 25 shares of PANW at the market price. Not a commission on this trade, but there can be on some types of trades. With market orders, prices can change quickly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. Send that order off, and should fill here any moment. There we go. Bought that for $195.44. All right, guys, we've accomplished what I set out to do today. I wanted to introduce what turned out to be, at least in the self-feedback that I saw provided by my audience members, this is a new indicator to just about everybody out there. That's kind of fun for me as a presenter to bring new tools into the discussion. It's not a sales pitch ever for any individual approach or for the use of a specific tool. We like to just explore the possibilities of what's available on Thinkorswim. So I hope you enjoyed that. Max is saying, could we do trading of other things rather than just stocks? Yeah, conceptually we could. Now, regardless of whether stocks or something else, it's not a guarantee that it's going to deliver, right? That's why the trader probably wants to have a plan for when they're going to take profits, but also when they might take losses. All right, everybody. Hope you enjoyed that introduction to the Klinger oscillator. We looked at our existing positions, we looked at the markets, we introduced and traded the new indicator, created a new system using that. We'll follow up on this in future webcasts. So make sure that you have subscribed to our Trader Talks channel if you haven't done that already. There's the name, Trader Talks Schwab Coaching Webcasts. That's our channel on YouTube. You can go down and click on the subscribe button right now. Take that 1 second. It doesn't cost anything. But this is where you can find our playlists of previous webcasts. You can also join our live streams here, and you can do searches for keywords like our trend value momentum chart trading system. Thanks, Mike, for helping out in chats. I definitely appreciate your help. Everybody, you should be following Mike and me on X. You can find Mike there at Mike Fairborn CS. You can find me on X at Cameron May CS. It literally is the best place to connect. It's the only place. Every once in a while, well, anyway, no, I'm just going to say, if you reply to one of my posts on X, I try to reply right back to you. I've replied to a number of posts replies just today, and it can be valuable. Additional resources here, like this introduction to. I had a question that came in the YouTube comments. I said, "Hey, Coach Cam, how come I can't get tick charts on Thinkorswim?" You can. So I showed how to do that here in this little 2-minute video, and I had a little tip for a different way to view those tick charts once they're loaded. Anyway, so you may want to check that out. But another thing that I definitely appreciate is so many people have already clicked the thumbs up. We have 152 people watching, and I can see how many people have clicked that like button. 75. Wow, that's half. Awesome. I think that's the best ratio I've ever had. Yeah, if you enjoy these webcasts, make sure you click the thumbs up. That is like a pat on the back to your presenter for doing a good job. It also boosts their webcast and YouTube algorithm, helps people learn new things like how the Klinger oscillator might be built into a trading system. All right, everybody, go have a great Friday. Enjoy your weekend. I will see you next week. We still have a few more webcasts on the agenda for today, so go enjoy those. I'll look for you in those future webcasts. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.